Disclaimer.
February 6th marks a critical threshold in our silver markets, and most investors won't realize what's happening until it's too late. In just 2 days, we hit the moment when access to physical silver through traditional futures markets begins to fundamentally change. 3 days later, on February 9th, the CME Group launches a brand new 100-ounce silver futures contract that creates what I am calling the lockout, a mechanism that will separate those who can access physical metal from those who can only chase paper prices. Here's what makes this window so critical. In just 7 days during late January, 33.45 million ounces of silver vanished from COMEX registered inventory. Let me put that in perspective for you. That's 26% of the available delivery stock disappearing in a single week while we're heading straight toward March contract first notice day on February 27th. Registered inventory has been declining dramatically, and open interest in silver futures contracts is demanding far more physical metal than actually exists in these vaults. The timing between February 6th and February 9th creates a narrow window that sophisticated players are already moving through while retail investors remain unaware. You might be wondering what makes these specific dates so significant. CME announced this new contract on January 13th with a February 9th launch date, and the contract design itself reveals the strategy. This is not like traditional silver futures that give you the option to take physical delivery of actual metal. This contract is financially settled, meaning cash only. When your contract expires, you receive dollars based on silver's price, not actual bars of silver sitting in a vault with your name on them. Think about what this means for the February 6-9 window. Before the 9th, anyone buying silver futures still has a theoretical access to the physical delivery mechanism, despite the strain we're seeing in registered inventory. After the 9th, new demand gets channeled into this cash-settled contract that specifically excludes physical delivery. We're watching the creation of a two-tier system in real time, where retail traders and smaller players get directed into paper contracts, while only the largest institutional players maintain access to physical metal. February 6th represents the last moment before this bifurcation becomes the new normal. The market itself is telling us something urgent through price behavior that contradicts normal trading patterns. Silver just experienced a historic crash in late January, plunging from an all-time high near 122 per ounce on January 29th to below 80 within hours on January 30th, a catastrophic 27% to 36% single-day decline that rivals the 1980 Hunt Brothers collapse. According to CME data, margin requirements spiked dramatically in response, jumping from 11% to 15% of contract value, a 36% increase. Higher margins typically cool off delivery demands because traders need more cash up front to maintain their positions. But the opposite is happening right now in our markets. Traders are engaging in what's called backward rolling, and this behavior reveals genuine concern about physical availability. Instead of rolling their positions forward into later contract months at lower prices like they normally would, these traders are actually pulling their deliveries forward and paying premium prices to take possession now rather than waiting. When sophisticated market participants willingly pay extra to get their hands on physical silver immediately, that's not speculation. That's a signal about supply confidence or lack thereof. And they're doing this before February 9th changes the game entirely. Have you noticed how quiet mainstream financial media has been about these developments? You won't see urgent headlines about COMEX delivery mechanics on your evening news, even though the math here affects everyone holding silver investments or mining stocks in their retirement accounts. The registered inventory numbers come straight from COMEX's own daily reports, publicly available data that anyone can verify. Yet the implications of 33.45 million ounces leaving registered status in 7 days during this specific window haven't generated the analysis this situation deserves. Let me walk you through what registered inventory actually means, because this distinction matters enormously right now. COMEX reports total silver inventory around 440 million ounces, a number that sounds reassuring until you understand the categories. That total includes both eligible and registered silver. Eligible silver sits in COMEX-approved vaults, but isn't available for immediate delivery against futures contracts. Registered silver is specifically warranted for delivery, the actual metal that backs those futures contracts when traders stand for physical delivery. The registered pool has been depleting at an accelerating rate, while open interest in active contract months demands more metal than exists. You can own a futures contract with full intention of taking delivery, but if registered inventory can't meet those demands, the exchange has mechanisms to force cash settlement instead of physical delivery. The February 6th to 9 window matters because after the 9th, this forced settlement becomes systematized through the new contract design rather than being an emergency measure. Current registered silver represents only about 30% of that total 440 million ounce figure that gets quoted in market updates, and it's this specific pool facing unprecedented strain. Samsung recently secured exclusive purchasing rights to the entire output of Mexico's La Parrilla mine for 2 years through a direct prepayment deal announced in October 2025. The technology giant provided $7 million in upfront financing to restart the mine, gaining the right to purchase 100% of all lead, silver, and zinc concentrates produced through 2027. Tesla and other major tech companies are following similar strategies, bypassing the COMEX system entirely to lock in physical supply through mine direct agreements. When industrial giants, who actually consume massive quantities of silver for manufacturing, decide the spot market and futures exchanges are too unreliable for securing supply, that tells you something fundamental has shifted in market structure. And they made these moves before February 6th for good reason. The structural deficit in silver markets reached 148.9 million ounces in 2024 alone, according to the Silver Institute's World Silver Survey. That's demand exceeding mine supply and recycling by nearly 150 million ounces in a single year. Over the past 4 years, cumulative deficits total approximately 658 million ounces. These aren't projected numbers or theoretical models. These are actual consumption patterns from industrial, investment, and jewelry demand measured against actual mining production and scrap recycling. Where does that deficit silver come from when annual demand exceeds annual supply? It comes from existing stockpiles, including exchange inventories like COMEX registered silver. So when you see 33.45 million ounces leaving registered status in 7 days, you're watching the physical manifestation of years of structural deficits finally impacting the very inventories that are supposed to provide confidence in paper price discovery. And February 6th marks the threshold before the exchange officially acknowledges this reality through contract redesign. The February 9th launch creates a cash-settled alternative at the exact moment when the physical delivery system faces its most acute pressure in years. The March contract first notice day falls on February 27th, just 18 days after this new trading vehicle goes live. During those 18 days following the launch, traders who want exposure to silver's price movements will have a choice. Buy the traditional contract with physical delivery capability but higher margins and tighter inventory, or buy the new cash-settled contract that tracks silver's price without any claim on physical metal. The exchange's timing creates a pressure release valve for paper silver demand, right when physical delivery pressure would otherwise force uncomfortable conversations about inventory adequacy. New money flowing into silver markets after February 9th will likely choose the path of least resistance, the cash-settled contract with simpler mechanics and no delivery complications. This effectively channels fresh demand away from the physical delivery system that is already showing strain through elevated lease rates, delivery bottlenecks, and the backward rolling behavior we're seeing from informed traders. What makes February 6th the lockout date is simple mathematics and timing. It's the last full trading day before the weekend that leads into the February 9th launch. Any positions established before this date operate under the old rules, where physical delivery, however strained, remains the theoretical endpoint of futures contracts. After February 9th, the market structure officially changes to accommodate a world where cash settlement becomes the primary mechanism for most traders, with physical delivery increasingly reserved for those with the size and relationships to navigate the shrinking registered inventory pool. You're watching the construction of a two-tier market in real time, where paper prices and physical availability are beginning to diverge in ways we haven't seen before in modern silver trading. February 6th through 9th represents the transition window when one system transforms into another. Despite silver's dramatic correction from its $122 peak to current levels around $85, $90 per ounce, the fundamental supply dynamics haven't changed. Only the price has adjusted after the most volatile trading session in decades. What happens during these specific days might determine whether physical silver remains accessible at anything close to the paper prices being quoted on screens across America, or whether we see the kind of premium divergence that is already appearing in Asian physical markets, where buyers pay 20 to 40% over spot to secure actual metal. The question is not whether COMEX will experience delivery pressure on March 1st notice day. The math already tells us the system is under strain. The question is whether the February 9th launch successfully redirects enough demand into cash-settled paper to prevent that pressure from forcing visible market disruptions. And the answer to that question depends partly on how many investors understand what is happening during this February 6 to 9 window, while they still have choices about how to position themselves in silver markets that are fundamentally changing before our eyes. The story of what is really happening in our silver markets is not speculation or theory. It is written in delivery data that anyone can verify through COMEX's own reporting systems. On January 7th, 2026, something unusual appeared in the delivery records that should make every precious metals investor pause and pay attention. According to COMEX data from that day, holders of 1,724 January silver contracts received delivery of 8.1 million ounces of silver from COMEX warehouses. What makes this delivery remarkable isn't the volume, it's the concentration. JP Morgan issued 99% of those delivery warrants. Think about that for a moment. Out of 8.1 million ounces delivered on a single day, one institution handled the issuing side for essentially all of it, distributing those warrants to multiple stoppers who were demanding physical possession. This isn't how a healthy liquid delivery market typically operates. When one major player dominates the issuing side of deliveries to that degree, it suggests that either other holders do not have metal available to deliver, or they're unwilling to part with it at current prices, or the logistics of delivery have become concentrated in ways that should concern anyone relying on COMEX for price discovery. The concentration of delivery activity through JP Morgan comes at the exact moment when registered inventory is experiencing unprecedented withdrawal rates. Remember those 33.45 million ounces that left registered status in 7 days? That withdrawal happened during the same period when delivery demands were being funneled through a single dominant issuer. The data reveals a delivery system under stress, where the theoretical abundance of silver inventory reported in total COMEX holdings isn't translating into widespread, distributed delivery capability when contracts actually come due. But the strain isn't just visible in delivery mechanics, it's showing up in price structure itself. Silver futures are trading in backwardation, a condition where near-month contracts trade at premiums over distant contracts. This is the opposite of normal commodity market structure. Typically, futures contracts further out in time trade at premiums because of storage costs and the time value of money. When backwardation appears, it signals that immediate physical possession is more valuable than promises of future delivery, a clear indication that market participants doubt the reliability or availability of physical metal in the delivery system. Let me show you how industrial players are responding to this uncertainty. Samsung's October 2025 deal with Silverstorm Mining for the La Parilla mine represents more than just a financing arrangement. It's a complete bypass of traditional commodity markets. By providing $7 million in upfront capital, Samsung secured the right to purchase 100% of all lead, silver, and zinc concentrates from that mine for 2 full years. The mine is expected to produce silver through 2026 and 2027, and none of that metal will ever touch COMEX warehouses or participate in exchange price discovery. Samsung has effectively removed future mine supply from the spot market entirely. This strategy reflects a fundamental shift in how major industrial consumers are thinking about silver supply. When you're Samsung and you need silver for electronics, manufacturing, solar panel production, and various technology applications, you can't afford supply disruptions. The 148.9 million ounce structural deficit in 2024 meant that global silver demand exceeded newly mined supply and recycled material by nearly 150 million ounces. Where did that deficit come from? Existing stockpiles, including the exchange inventories we've been discussing. Companies watching those inventories decline while prices show extreme volatility are making rational decisions to secure supply outside the increasingly unreliable spot and futures markets. Tesla has followed a similar path, though the company doesn't publicly disclose the specific details of its silver procurement strategy. What we know from industry sources and supply chain analysis is that major electric vehicle manufacturers and solar panel producers are increasingly entering into direct agreements with mining companies and refiners, establishing supply chains that don't depend on exchange-traded markets. When you're manufacturing vehicles and solar installations that require significant quantities of silver, the last thing you want is exposure to the kind of 36% single-day price crash we witnessed on January 30th, or the supply uncertainty that comes from relying on shrinking exchange inventories. The cumulative 4-year deficit of 678 million ounces tells you why this industrial lockup strategy makes sense. That's 678 million ounces of demand that exceeded supply and had to come from somewhere. COMEX registered inventory, at its current depleted levels, represents a fraction of that cumulative deficit. The industrial players who actually consume silver in manufacturing understand that relying on spot markets and futures exchanges for reliable supply has become increasingly risky as years of deficits have drawn down the buffer inventories that once provided market stability. Now, here's where the exchange mechanics get revealing. COMEX reports both eligible and registered inventory, but the distinction has enormous implications that most investors don't fully grasp. Eligible silver totals around 320 million ounces, while registered silver available for immediate delivery against futures contracts has been declining dramatically. The process of converting eligible to registered is automatic. It requires the metal owner to specifically warrant that metal for delivery, pay associated fees, and make it available through the exchange system. What we're seeing in current market conditions is that eligible to registered conversions are keeping pace with delivery demands and registered inventory withdrawals. Metal sitting in eligible status belongs to someone, and those owners are choosing not to convert it to registered status, even as registered stocks decline and delivery premiums appear. This tells you that the owners of eligible silver either need it for other purposes, believe prices will go higher, or simply don't want to participate in the exchange delivery system at current price levels. Whatever their reasoning, the result is the same. Registered inventory that's actually available for delivery continues to shrink. The February 9th launch of the cash-settled contract creates a parallel market at precisely the moment when this dynamic is reaching critical pressure. Think about what happens when retail investors and smaller institutions want silver exposure after the 9th. CME's own announcement positioned the new contract as improving access for retail traders looking to diversify their metals exposure. Jin Hennig, CME's managing director and global head of metals, stated that the 100-ounce contract would improve access to a wider range of participants, enabling them to benefit from the liquidity and efficiencies that our futures markets provide. Robinhood's VP of Futures and International JB McKenzie emphasized that the contract offers customers a way to trade silver with less capital. The marketing sounds beneficial for retail access, and in some ways, it is. Smaller traders can participate in silver price movements without the capital requirements of full-sized contracts. But here's what the marketing doesn't emphasize. Every dollar of new demand flowing into that cash-settled contract is demand that won't be testing the physical delivery system. The exchange is effectively channeling retail demand away from the mechanism that's showing strain, physical delivery against futures contracts, and into a purely financial product that settles in cash based on the price of silver determined by that same strained physical system. Lease rates provide another window into physical market tightness. Silver lease rates represent the cost of borrowing physical metal, and elevated lease rates indicate that holders of physical silver are demanding significant compensation to lend it out temporarily. When lease rates spike, it signals that physical metal holders believe either that prices will rise, making them reluctant to lend at fixed rates, or that getting metal back when the lease expires might be difficult. Recent periods have seen silver lease rates reach levels suggesting genuine concern about physical availability, with borrowing costs spiking to annualized rates that would be unprecedented in normal market conditions. Delivery bottlenecks compound these concerns. Even when metal exists in registered status, the actual logistics of delivery, transferring ownership, arranging transport, handling documentation, moving metal between vaults, can create friction during periods of high delivery demand. The concentration of January 7th deliveries through JP Morgan suggests that these logistical pathways have become concentrated, potentially creating single points of failure or delay in a system that is supposed to provide reliable physical delivery to any contract holder who stands for metal. The official narrative from exchanges and major banks emphasizes that the silver market remains deep, liquid, and well supplied. They point to total COMEX inventory of 440 million ounces and describe the January price crash as a healthy correction after an overheated rally. But the actual behavior of market participants tells a different story. Backward rolling, where traders pay premiums to pull forward delivery dates, doesn't happen when participants are confident about future supply. Industrial players don't bypass entire commodity exchanges to lock in mine output when they believe spot markets will reliably provide metal. JP Morgan does not end up issuing 99% of delivery warrants on a given day when the delivery system is functioning normally with distributed competitive participation. February 9th. This launch matters because it represents an official acknowledgement that the traditional futures market structure needs modification to handle current market conditions. The exchange is creating a safety valve that allows continued price discovery and trading activity without forcing the physical delivery system to accommodate all that trading interest. In theory, this makes sense. Not everyone trading silver futures wants physical delivery, so why not offer a product that matches that need more efficiently? The concern is what this reveals about the underlying system. If physical delivery capability were abundant and reliable, there would be less urgency to create cash-settled alternatives. The timing, announced January 13th for February 9th launch, just weeks before March contract first notice day, suggests that exchange operators are watching the same delivery data, inventory trends, and backwardation signals that we can all see in public reporting. They're watching registered inventory decline while open interest remains elevated, and they're creating a mechanism to manage that pressure before it forces uncomfortable situations during March delivery period. You're watching the construction of a two-tier silver market where paper and physical are officially diverging through product design rather than just through occasional premium spreads. After February 9th, silver trading splits into two distinct streams. One where metal changes hands and delivery remains possible, though increasingly strained, and another where only cash changes hands based on prices discovered in that same strained physical system. The question becomes whether prices discovered in a system where most participants trade cash-settled contracts can accurately reflect the underlying physical reality when physical delivery capability is limited to an increasingly small group of major players. Asian physical markets already show this divergence, with premiums of 20-40% over spot, appearing as buyers compete for actual metal outside the Western exchange system. If that premium structure spreads more widely, investors holding cash-settled paper contracts will discover that their financial exposure to silver prices doesn't translate into ability to obtain physical metal at those same prices. They'll have made a bet on a price, but the price they're betting on increasingly reflects a parallel market where most participants have no intention or ability to take delivery of actual metal. February 6th represents the last moment before this bifurcation becomes institutionalized through product structure. The delivery data, industrial behavior, lease rates, and backwardation are all pointing in the same direction, toward a physical silver market under significant strain. The February 9th launch is the exchange's answer to that strain, creating a path for continued trading activity that doesn't challenge the physical system. Whether that's solving a problem or just postponing a reckoning depends on what happens. When March deliveries come due, and the newly channeled demand hasn't relieved pressure on a registered inventory pool that continues declining toward levels that can't meet historical delivery demands. Let me walk you through the mathematics of what's building toward February 27th, because the numbers tell a story that anyone with exposure to silver markets needs to understand. The calendar creates a compression point that hasn't existed in modern COMEX history, where multiple pressures converge in a window so narrow that creates both challenges and opportunities for those who understand what's unfolding. March 1st, notice day falls on February 27th, exactly 18 days after the February 9th launch of the cash-settled contract. Think about that timeline. The exchange introduces a new trading vehicle designed to channel demand away from physical delivery, and that vehicle has barely 2.5 weeks to redirect enough interest before the March contract enters its delivery period. During those 18 days, traders need to discover the new product, understand its mechanics, shift their positions if they choose, and establish new trading patterns. That's an extremely compressed timeline for what amounts to a fundamental restructuring of how retail and smaller institutional participants access silver price exposure. Current silver prices, around 87 per ounce, sit 28% below the $120 peak reached on January 29th, yet they remain 173% above levels from a year ago. This price position creates an interesting dynamic. The correction from $122 shook out leveraged speculators and forced margin liquidations that reduced open interest somewhat. But it didn't fundamentally change the supply-demand imbalance in physical metal. The same industrial deficits exist, the same mine supply constraints persist, and the same registered inventory depletion continues. What changed was sentiment and leverage, not the underlying physical reality. Now let's look at what happens if registered inventory continues depleting at the pace we observed in January. During that 7-day period in late January, 33.45 million ounces left registered status. If we conservatively assume that pace continues, though there's no guarantee it will slow down or accelerate, we can project forward to February 27th. From today, February 4th, to March 1st, notice day represents 23 days. At roughly 4.8 million ounces per day of withdrawal based on that January pace, you're looking at potential additional depletion of over 110 million ounces before March deliveries begin. Even if the pace slows by half, that's still 55 million ounces of additional pressure on a registered pool that can't afford to lose much more. The registered inventory that actually backs physical delivery against futures contracts has already been drawn down to levels that make exchanges nervous. When you combine declining available inventory with open interest that remains elevated despite the price correction, you create a mathematical problem that has only 3 possible solutions. Either registered inventory stops depleting, which would require physical holders to suddenly reverse course and deposit metal into the system, or open interest in contracts demanding delivery drops dramatically, as traders voluntarily exit positions or roll them into later months. Or the exchange implements mechanisms to reduce delivery demands through cash settlement, contract modifications, or other interventions. History suggests that voluntary reduction in delivery demands during periods of backwardation and elevated lease rates is unlikely. When markets trade in backwardation with front-month premiums of 288, it signals that immediate possession has specific value to participants. They're not taking delivery because they want to trade futures. They're taking delivery because they want the metal itself, whether for industrial consumption, inventory building, or concerns about future availability. These participants don't typically change their minds because an exchange offers a cash-settled alternative. They came for metal, and cash settlement doesn't satisfy that objective. This brings us to the 3 scenarios that could play out between now and the end of March. And the probability of each depends heavily on decisions made during this February 6 through 9 window. Let me walk through what each scenario looks like and what would need to happen for it to materialize. The conservative scenario assumes that the February 9th cash-settled contract successfully redirects enough new demand to prevent additional stress on the physical delivery system. In this case, registered inventory depletion slows as fewer contracts stand for delivery in March compared to January. The exchange manages the delivery period without major disruptions, though premiums for physical delivery over cash settlement might widen to 5 to 10% as the market acknowledges the two-tier structure. Silver prices in this scenario would likely range between $100 and $120 through the end of Q1 as delivery premiums normalize and the market adjusts to the new contract structure. This scenario requires that industrial players who need physical metal have already secured their supply through direct agreements like Samsung's offtake deal, reducing pressure on exchange inventories. The moderate scenario envisions a registered inventory breach where available metal drops below levels that can comfortably satisfy March delivery demands. COMEX has never officially run out of deliverable silver, but there are levels below which the system becomes operationally stressed even if metal technically remains available. When registered inventory approaches these critical thresholds, the exchange typically implements operational changes, perhaps adjusting delivery procedures, encouraging eligible to registered conversions through incentives, or facilitating off-exchange settlements between buyers and sellers who don't want to stress the warehouse system. In this scenario, silver prices would likely push toward the $120, $150 range, as physical delivery premiums widen significantly, and participants recognize that obtaining metal through COMEX has become more complicated than advertised. The cash-settled contract would trade at increasing discounts to physical delivery contracts, officially bifurcating the market into paper and physical tiers. The aggressive scenario contemplates what happens if multiple contract months simultaneously demand physical delivery beyond available registered inventory. This would occur if March deliveries proceed at elevated levels, while April and May contracts also show unusual delivery interest. Perhaps because industrial consumers who missed securing supply through direct mine agreements are now competing for exchange inventory. In this case, registered stocks could decline toward levels where the exchange must either encourage cash settlement through various mechanisms or face the prospect of delivery defaults. Silver prices in this scenario could surge toward $150, $108 or higher as the premium for actual physical delivery over cash-settled paper expands to 30 to 50% or more, similar to what we've already seen in Asian physical markets. This scenario would represent a fundamental breakdown in COMEX's role as the primary silver price discovery mechanism. What makes the current moment so critical is that the February 6 or 9 window determines which scenario becomes most probable. Before the 9th, anyone establishing positions in silver futures operates under the existing system where physical delivery remains the theoretical endpoint. After the 9th, new participants have a choice, and that choice will influence how much additional pressure the physical delivery system faces. If the cash-settled contract successfully attracts the majority of new retail and smaller institutional demand, it reduces the probability of the aggressive scenario. If traders continue preferring delivery-capable contracts despite higher margins and operational complexity, the pressure on registered inventory continues building. Consider the specific sequence of events that must unfold. February 6th is the last full trading day before the weekend leading into the launch. Positions established on the 6th operate under current rules. The 9th launches the new contract with its cash settlement mechanism. From the 10th through the 27th, just 17 trading days, the market discovers whether the new structure successfully diverts demand. On the 27th, March 1st notice day arrives, and we see actual delivery intentions. From the 28th through the end of March, physical deliveries either proceed smoothly or they don't. The price action during this sequence will tell you everything about which scenario is unfolding. If silver prices remain relatively stable in the 85 to 95 range through mid-February with modest volatility, that suggests the conservative scenario where the new contract is working as intended. If prices begin pushing back toward $100 and $110 with widening spreads between delivery-capable and cash-settled contracts, the moderate scenario is emerging. If prices surge above $120 with reports of delivery difficulties, extended settlement times, or unusual EFP, exchange for physical activity, the aggressive scenario is materializing. What investors need to understand is that this is not speculation about what might happen in some distant future. The mathematical pressure exists right now in publicly reported data. Registered inventory depletion is factual. Open interest numbers are published daily. Backwardation in the futures curve is observable in real-time pricing. Lease rates at 8% are verifiable through multiple sources. The February 27th first notice day is on the calendar and isn't moving. These aren't predictions. They're constraints that will force some form of resolution. The February 9th launch of the cash-settled contract represents COMEX's attempt to add a release valve before that pressure reaches critical levels. Whether it works depends on adoption rates, which we can only observe as they develop. What we know with certainty is that the window between the launch and March delivery is extraordinarily narrow by historical standards for such a significant market structure change. For anyone holding physical silver, these scenarios suggest that the premium your metal commands over paper prices could widen significantly depending on which pathway unfolds. For anyone trading silver futures with intention to take delivery, understanding the distinction between delivery-capable contracts and cash-settled alternatives becomes crucial over the next 3 weeks. For anyone considering new positions in silver, the February 6 to 9 window represents the last opportunity to establish exposure under the current system before the market structure officially bifurcates. The calculation is simple, even if the implications are profound. Diminishing registered inventory plus elevated delivery demands plus compressed timeline equals forced resolution through some mechanism. That mechanism will either be voluntary demand, reduction through cash-settled alternatives, involuntary demand reduction through price-driven position liquidation, or system stress that forces operational changes to delivery procedures. Mathematics doesn't care which mechanism activates, it only requires that one of them does, because the current trajectory is unsustainable past March delivery period without some form of adjustment. You're watching in real time as a major commodity exchange attempts to manage physical supply constraints through financial engineering. The February 6th through 9th transition window is when that engineering goes live. The February 27th first notice day is when we discover whether it worked. In the weeks between now and the end of March, we'll determine whether silver markets emerge from this period with a new stable structure or whether the strain we are observing in delivery data lease rates and backwardation intensifies into something more disruptive. The numbers are public, the timeline is set, and the mathematics are unforgiving.